Silver just printed $106.55 in the dead zone of the week. Sunday night, thin liquidity, sleepy desks, retail gone, the safe hours when nothing is supposed to happen. And it didn't crawl there. It teleported there. In minutes. That is not a normal rally. That is not healthy price discovery. That is the sound of a market snapping a load-bearing beam and hoping nobody heard it. Welcome back to this channel. Before we go any further, tap subscribe right now. Not because this is exciting, because the next phase of markets is going to punish people who only watch headlines. And drop a comment. Was this a glitch or a warning shot? I want your take because this move has fingerprints all over it. Now let's walk through what actually happened. It was a quiet Sunday evening, the exact time window when the financial system likes to do surgery in the dark. The pits are closed, the talking heads are off air, liquidity is thin, market depth is a skeleton. That's when Globex opens its overnight session, and you get the version of price discovery that's half algorithm, half confession. And right after that open, silver didn't trend, it exploded. The chart went vertical. The kind of vertical that doesn't look like buying pressure. It looks like urgency. Like someone wasn't shopping for a good entry. They were paying whatever they had to pay because they needed to be long immediately, or they needed to get out of a position immediately, or they needed to secure exposure before a window slammed shut. Here's the key detail most people miss. In thin markets, massive moves are supposed to be down. When liquidity dries up, bids disappear, and the first wave of fear can air pocket the price. That's why flash crashes happen. That's why you see waterfall candles. But an upside spike in thin liquidity is different. It suggests somebody hit the ask like they didn't care how far it ran because the cost of waiting was worse than the cost of overpaying. That's not casual speculation. Speculators love depth. They love hiding their size. They love slicing orders, minimizing impact, playing the spread. This did not behave like a tourist trade. This behaved like a forced trade. And when you see a forced trade in silver, of all markets, you have to stop asking what's the headline and start asking what's the stress point. Because silver is not like crude oil, where supply shocks can ripple overnight and everybody understands why. Silver is the strange metal. It's traded like a monetary asset, mined like a byproduct, consumed like a critical industrial input, and priced, most of the time, like a paper abstraction. Which brings us to the uncomfortable part. Most silver traded every day isn't silver. It's contracts. It's promises. It's paper claims on future delivery, swapped back and forth like casino chips, with the assumption that almost nobody will ever ask for the metal. And that assumption is exactly what gets tested when the price does something violent outside regular hours. Because when a market that is built on rolling paper suddenly reprices in the dark, it's not just moving. It's revealing where the system is weakest. So let's talk about the weakness. A futures exchange can function smoothly as long as two beliefs hold. Belief number one, there will always be enough liquidity to absorb large flows without breaking the chart. Belief number two, if a meaningful number of participants demand physical delivery, the system can meet those obligations without panic. Silver has been wobbling on both beliefs for a while. For months, physical buyers have been paying premiums that make the spot price feel fictional. Coins, bars, popular retail products, often priced several dollars above the paper quote. Dealers talk about delays, sourcing issues, refining bottlenecks, back orders, allocation. Those words are polite language for the same thing. The metal is not flowing like it used to. And if paper price is calm while physical is tight, that's a warning on its own. But if paper price suddenly spikes like a heart monitor during a quiet shift, that's the market hinting that the gap between paper silver and real silver is becoming harder to ignore. Now, I'm not going to ask you to trust rumors. You don't need rumors. You only need logic. Ask yourself this. If silver were abundant, if inventories were comfortable, if supply chains were loose, if refineries were swimming in feedstock, would you see repeated episodes of scarcity pricing at the retail level? No. You'd see discounts. You'd see mints flooding the market. You'd see dealers competing on price. Instead, you see stubborn premiums that don't care what the chart did last week. That's not sentiment, that's friction. And friction is what you get when a market is running a deficit. Here's the number that matters, even if executives avoid saying it out loud. The world has been consuming more silver than it replaces. Year after year, demand has had a habit of running ahead of mine supply and recycling supply combined. At first, that's fine. Above-ground stockpiles exist. Vaults exist. Inventories exist. The system can bleed for a while. But every deficit is a subtraction from a buffer. And buffers only look infinite until the day they don't. Picture a reservoir. You can drain it slowly for years and nobody panics. The surface still looks calm. Then one summer you hit the mud line and suddenly every politician is giving speeches about water. Silver is at that psychological stage. Not because it's rare in a museum sense, but because the industrial world is locking it into devices faster than the supply chain can replenish it. And now we have to talk about why replenishing it is not as easy as higher prices. Most people assume higher prices create more supply. That's true in some commodities. Silver is a different beast. Because most newly mined silver does not come from silver mines. It comes as a byproduct of mining other metals: lead, zinc, copper. The primary economics are driven by base metals, not silver. So even if silver price screams higher, a big chunk of the production base cannot instantly respond with a flood of new ounces. Their decision-making is tied to copper demand, zinc demand, lead demand, permitting, processing capacity, and the geology of their existing ore bodies. And geology has been quietly tightening the noose. Ore grades decline over time. The high-grade, easy, near-surface discoveries don't last forever. As grades fall, miners must process more rock for the same output, which increases energy use, increases costs, increases environmental resistance, increases political risk, increases time. So you get a supply curve that does not bend easily. And right when supply is stubborn, demand is turning structural. This is where the story gets nasty. Because silver demand isn't being driven by a fashion trend, it's being driven by national policy and industrial necessity. Solar is not a hobby anymore. It's a state-backed build-out. Every solar panel needs conductive paste. Silver is the best conductor in the periodic table. You can fight physics with slogans for a while, but physics always collects its debt. EVs are not a niche anymore. They're becoming a mandate in multiple regions. EVs use more silver than internal combustion vehicles because electronics scale, power management systems scale, charging infrastructure scales, high reliability contacts scale. And even if you argued about the exact grams per vehicle, you don't need precision to understand direction. Millions of vehicles times more silver per vehicle equals a demand curve that ratchets upward like a gear. Then you have grid infrastructure, data centers, high-density electronics, telecom, 5G and beyond, defense. And defense is the part nobody likes to discuss because it turns the metal from investment to priority allocation. Modern weapons and modern surveillance are electronic systems: guidance, radar, secure communications, shielding, reliability. Those systems are silver-hungry in exactly the way a fragile supply chain can't afford. Add medical demand, antibacterial applications, coatings, specialized uses, and you get demand that doesn't politely go away during a recession. Some of it may soften, sure, but the core trend is locked into infrastructure plans and multi-year contracts. This is why that Sunday night spike matters, because it's not just a trade. It's a moment where the market, briefly, acted like it understood the full stack of demand pressures and the thinness of the supply cushion. Now zoom out. There's another force pressing on silver, and it's not industrial. It's monetary. The modern world just lived through an era of currency expansion that trained serious capital to distrust paper promises. When central banks flood the system with units, the units don't disappear. They chase assets. They chase commodities. They chase stores of value. They chase anything that cannot be printed. Gold gets the respect. Gold gets the headlines. But silver is the awkward cousin that does two jobs. It acts like money when trust collapses, and it acts like a critical input when industry accelerates. That dual identity is why silver behaves like a trapdoor market. Most of the time it's quiet. Then, in certain conditions, it reprices violently because it's being pulled by two engines at once. And the global monetary order is giving it plenty of fuel. For decades, the world ran on a simple belief. Reserves held in major currencies were safe, neutral, apolitical. Then we watched reserves get frozen. We watched payment rails become weapons. We watched geopolitics invade settlement mechanics. And once that happens, every finance ministry on earth quietly asks the same question. If our reserves can be frozen, are they reserves? Or are they just entries on someone else's spreadsheet? That's why you've seen a renewed appetite for hard assets, especially among entities that think in decades, not quarters. And here's the uncomfortable link back to your Sunday night spike. When trust degrades, markets become prone to discontinuities, because everyone is fine until they're not. Everyone rolls the paper until someone demands metal. Everyone assumes liquidity until liquidity disappears. Everyone believes the price is real until the price becomes a number that doesn't clear the physical market. So when you see $106.55 print during the quiet session, don't just stare at the number. Ask why that number appeared there at that time in that structure. Because the location of the move is part of the message. Off hours is where a lot of repositioning happens. It's where gaps form. It's where thin order books allow large players to move price with less resistance. Sometimes it's accidental. Sometimes it's a chain reaction. But even if it was triggered by a mechanical event, an algorithm, a stop cascade, a liquidity vacuum, the bigger point still stands. The system is fragile enough that a relatively small imbalance can create an outrageous price print. And fragility is not a comforting trait in a market that underpins energy transition technologies and monetary hedging simultaneously. Now comes the part where you, as a serious viewer, stop being entertained and start being strategic. Because after the spike, the question isn't, will it happen again? The question is, what does this do to behavior? Markets are reflexive. Price moves change expectations. Expectations change positioning. Positioning changes flows. Flows change price. A violent Sunday spike plants a seed in every risk manager's head. It reminds shorts that their risk isn't linear. It reminds industrial buyers that waiting can be expensive. It reminds long holders that volatility is going to be weaponized. And that last part is important. If silver is entering a scarcity-driven regime, you should expect psychological warfare. You should expect sudden drops engineered to shake out weak hands. You should expect spikes used to trigger margin calls. You should expect the chart to behave like a stress test designed to find who can't hold their position. Because in tight markets, the easiest way to get metal is not to mine it. It's to scare it out of someone else's hands. So what do you do with that reality? First, you don't confuse a single print with a stable new price. That spike is a flare, a message, a clue. The deeper story is supply, demand, and trust. And you position based on probabilities, not emotions. Here are the three scenarios that matter. Scenario 1, the base case. Demand continues climbing, supply remains stubborn, inventories erode. Silver trends higher over time with violent swings. Not a straight line, a staircase with broken steps. In this world, patience beats panic. You don't chase every candle, but you also don't dismiss the direction. Scenario 2, the acceleration case. Industrial demand surprises to the upside, or a supply disruption hits a major producing region, or a monetary event forces institutions into hard assets at the same time industry is tightening the physical flow. That's when the gaps become frequent. That's when the paper price begins to look like a suggestion. That's when premiums widen. That's when delivery times stretch. That's when policymakers start talking about strategic materials. Scenario 3, the relief case. A recession slams industrial demand. Or substitution technology actually works at scale. Or supply ramps faster than expected. This can happen. It's just less convenient than people assume, because substitution is hard, mining is slow, and policy-driven demand doesn't turn on a dime. Now, here's the practical implication. If you are an industrial buyer, you stop treating silver like a cheap rounding error. You start thinking about supply assurance, long-term contracts, inventory buffers, diversified sourcing, because in a tight market, the thing you're buying isn't cheap metal, it's continuity. If you are a portfolio allocator, you stop thinking in meme terms, paper versus physical, as a slogan, and you start thinking in structure. Futures are liquid and leveraged, but they are claims. ETFs are convenient, but they introduce counterparty layers. Physical eliminates some counterparty exposure, but introduces storage, insurance, liquidity logistics. There is no one-size answer, but there is one universal mistake. Ignoring the warning because it doesn't fit your comfort zone. And listen, silver will test you. It will rip higher and make you feel brilliant, then it will slam down and make you feel stupid. Then it will do nothing for weeks. Then it will gap at a time that ruins your sleep schedule. That's how this market works when the underlying structure is tight. So here's what you watch next, if you want to stay ahead of the narrative. Watch the spread between paper quotes and physical reality. Premiums, availability, delivery times, out-of-stock signs. Those are the footprints of stress. Watch exchange inventory trends and delivery pressure, because a futures market can only pretend to be a physical market as long as nobody insists on the physical part. Watch lease rates and funding stress, signals that the market is paying up for immediate access to metal. And watch Asia. If the physical heartbeat of the market is firm while paper gets slammed, arbitrage becomes a pressure valve. Price suppression has a limit when real buyers can lift cheap paper and translate it into higher physical demand elsewhere. Now I want to ask you something directly because this is where engagement matters. Do you believe that $106.55 was an accident that will be erased and forgotten? Or do you believe it was the market flashing its teeth for a second, showing you what it can do when the order book gets thin? Comment that. I read it, and it tells me how you're thinking. Because the final piece is psychological. If you understand the structural story, a sudden paper smash doesn't change the physics. A headline doesn't change supply constraints. A red candle doesn't create new mines. A jawboning official doesn't conjure ounces out of the ground. But volatility can still steal your position if you over-leverage, if you size wrong, if you treat this like a quick flip instead of a structural theme. That's the trap. Most people don't lose because they were wrong about direction. They lose because they couldn't survive the path. So if Sunday night was a warning, what was it warning you about? It was warning you that the market can reprice when you're not watching. It was warning you that the true risk isn't a slow drift, it's a discontinuity. It was warning you that the official number can become meaningless for a moment, and those moments are where fortunes change hands. And it was warning you that somewhere, someone cared enough to pay up in the dark. Now here's the cliffhanger you need to sit with. If silver can print $106.55 in off hours when liquidity is thin, what happens when the next real catalyst hits during full participation? What happens when industrial procurement gets more aggressive? What happens when investment flows collide with manufacturing demand at the same time? What happens when a quiet Sunday becomes the new normal? That's why you subscribe, because the next time the market speaks like this, it may not give you a clean rewind. And if you want to be early instead of emotional, you need to watch the structure, not the noise. Welcome to the phase where silver stops acting like a sleepy commodity and starts acting like a strategic asset. The chart just hinted at it. Now we watch whether the system tries to pretend it didn't happen, or whether the next move confirms that something behind the curtain has already broken.